Hello and welcome to the Deep Dive by STRAT. Mike, today we're talking recessions, and more specifically, the 5 biggest mistakes we see when managing investments throughout a recession.
Yep.
So let's take them one by one, and we'll talk about at the end why we think our recession signal mitigates some of these mistakes and what our recession signal is saying right now. So let's start with number 1, waiting for Ember, the National Bureau of Economic Research, the organization responsible for dating recessions. Mike, why should we not wait for Ember when it comes to recession timing?
If you average every Ember declared economic recession since 1960, the experience is that recession lasts about 9 months, but Ember doesn't declare that the US economy is in a recession until 6 months after when they say the start date was. Also, they don't declare that the US economy has exited a recession until about 7 months after it's already ended. So simply put, if you're waiting for Ember, you're just going to be too late. It's pretty much useless information. Now, you sort of give Ember a hard time here. It's really not their job to call a recession in real time.
Right.
So let's be safe there. But the second point that we want to make on this chart is we've designed our recession signal not necessarily to predict the gray shaded area, the recession, because if you're an investor, that's irrelevant. It doesn't matter if Ember says it's a recession or not, or if the US economy is actually in a recession. We designed our recession signal to predict when financial markets are likely to behave as if a recession is imminent. And if you look at these other dashed lines here, usually the equity market peaks about 6 months before the Ember recession date and really doesn't start selling off in a sort of nasty way until it's already started.
Right.
And the equity market usually bottoms, so you would want to be buying before the recession has even ended. So if you're an investor, you don't care about the gray shaded area. You don't care about the Ember recession dates. You care about these 2 time periods, the equity market, financial market drawdown associated with a recession. So that's what we're trying to predict.
Yeah, something interesting to be said. You definitely don't want to wait on Ember to sell. Maybe you wait on Ember to buy, given how closely this equity market bottom is to the average declaration of the start date. But I think that takes us into mistake number 2, right? Which is selling too early and or buying too late, right? So some of that market experience that you were just describing shown here across average recession time periods.
Common mistake. You know, we fell victim to this before as well. Nobody's perfect here. But a couple things. One, on the selling too early part. If we were to take this to its logical extreme, just to prove a point, and we were to say with certainty the US economy is going to enter a recession 5 years from now, in 5 years' time. One, we would probably be wrong because the US economy is way too dynamic. Way too much can happen within 5 years, let alone 5 months even, to reliably predict that a recession is going to happen. 2, when would that information, if it was correct, actually start to be useful?
Right.
And the answer is not for over 4.5 years.
Yep.
So what we're showing now around your typical Ember recession, dividing the pre-recession, during recession, and post-recession time periods into their average historical returns since averaging all recessions since 1960. And what you see is, like we said, the equity market peak is about 6 months before that recession starts. It really doesn't start selling off in a meaningful way until we're in about the first quarter of the recession. So you really want to wait. We like to say the US economy is innocent until proven guilty. And that sort of keeps from selling too early. A lot can happen. What's not shown here is so many instances where it looks like a recession may be developing, but a policy change is enacted, the private sector's too dynamic, whatever, and it's avoided. And then this entire sequence of events never happens. So if you're calling it 12 months out, odds are you're going to be wrong. On average, you're probably going to make more mistakes than you do get it right. So that's the thing on selling too early. And then buying too late. Once the market has declared, the US economy is guilty, and we all know we're in recession, you do not want to wait for the economic data to start improving in order to buy. You have to stop relying on the economic data. It's going to be bad for a long time. The market typically has its largest returns in sort of the fourth quarter of the recession, the last 25% of the recession. So we've designed, we're going to talk a lot about our recession entry signal. We've also designed a recession exit signal. And that exit signal has nothing to do with the economy. It's all based on market prices. Once we think equity markets and credit markets have sold off at a level that's consistent with past recessions, and that selling is starting to slow, that's when you sort of have to plug your nose and buy. Yeah. Our recession exit signal, exactly. It's the biggest opportunity. It's when there's the least certainty. It feels the most uncomfortable, but that's where the big gains are made. So that's when our recession exit signal kicks in and basically nullifies everything in our recession entry signal. Say, hey, this is about the risk-reward trade-off going forward. It's already gotten ugly enough. Plug your nose and start buying stocks.
Yep. And you referenced, looking at the data or waiting for the data to improve. And that brings us to our next biggest mistake here, trusting the wrong data, right? So what is the wrong data? We'll talk about what the right data is later, but give us an example here.
Yeah, generally speaking, the wrong data is economic data that is infrequent and subject to significant revisions, particularly around economic turning points. So to give a specific example there, one of the highest quality pieces of U.S. economic data, best forward-looking, is the monthly non-farm payrolls report.
Yep.
One recession rule that we've heard thrown around is when the 6-month moving average of monthly non-farm payrolls, so jobs added, goes negative, recession has started, you should sell. The problem with that, if we were to look specifically around the recession in 2001, the orange bars are 6-month moving average of monthly non-farm payrolls, the initial release, the information that the market had at the time. It does not turn negative until July 2001. The recession, turns out, had started in April 2001. And then what subsequently happened, this is what we mean, this is infrequent data, and it's heavily revised. Those non-farm payrolls data were revised, and that's what you see in the blue bars. And now, of course, it flipped negative in April, right when the recession started. And in July, we were already in the depths of what ended up being a pretty mild recession. So focusing on the wrong data, big issue.
And you noted it was a mild recession, but just look at the differences in these revisions down. I mean, it's in hindsight, it looks pretty clear, but in the moment, you're clear until July, right?
Yep, totally different view of the economy.
Yep. So into our fourth biggest mistake here, betting against American ingenuity. Yeah. This one's a little more specific for our domestic viewers here, kind of a benefit of being the global reserve currency, right? That comes in handy during recessions. Mm-hmm. So what we've got here, a couple of headlines on both sides of the ledger here. Talk to us about American ingenuity when it comes to recessions.
One of the least favorite questions we get from clients, we love all the questions, but maybe our least favorite would be, if a recession happens, or when we're in a recession, when the market has basically decided we're in a recession, how long will it last? How bad will it get?
Yep.
It is impossible to tell. Once everyone agrees that we're in a recession, anything can happen from that point.
Reaction functions change.
Exactly. And we have so many ingenious individuals in the public and private sector with incredible resources. Every single one of them wants to get out of a recession as quickly as possible, right? So you're sort of betting against American ingenuity. And the best example of that was probably the COVID recession, where, we've picked some headlines here and thinking about conversations we had with clients. One, doomed to fail, why a $4 trillion bailout couldn't revive the American economy, right? As if this is a recession that money couldn't solve. How bad might it get? Think the Great Depression. Why these economists say the recovery will be L-shaped. Remember all the shapes everybody busted out in 2020, the L, the V, the W, the K, whatever. This was, L is the worst of all the shapes. It would be like the Great Depression. And once we got in there, everybody wanted to get out. It was an unprecedented crisis, and you got unprecedented stimulus. $2 trillion worth of stimulus while Donald Trump was still president, followed by additional stimulus once Biden came into office.
Yep.
The Fed finds out, oh, actually, we can buy corporate bond ETFs, through a loophole and creating some special facilities. That's something they'd never done before. Just the threat of them buying corporate bonds single-handedly saved the corporate bond market.
Yep.
And then, of course, we get a vaccine for a novel virus that shows promising results in November of 2020. So once you're in there, it's hard to bet against.
Yeah.
And we say American ingenuity because, as you said, we also have the luxury of being able to print US dollars. And most recessions, at the end of the day, are problems that money can solve.
Yeah.
And we have tremendous capacity to print money. It's just, do policymakers have the willingness? If it gets bad enough, they will. And thankfully, we're in a position where, at least for now, the US dollar is still the world's reserve currency, and people still think it has value, even if we print trillions and trillions of it.
Yeah, I think this one relates heavily to the buying too late, right? It's when you start hearing and seeing headlines about Great Depression, this doomed to fail, that's generally a sign that this might be the bottom from a market perspective.
Yeah.
And that'll take us to our fifth and final biggest mistake to avoid, relying on one silver bullet. So we talked about looking at the wrong data earlier, but what do we mean by this, looking at one silver bullet?
There are so many economic papers, so many recession rules and signals that are being created that have a perfect track record. One of those is yield curve, the US Treasury yield curve. When it inverts, it has preceded every economic recession since World War II. And specifically, we're talking about when shorter maturity treasuries, like the 3-month, when the yield there is above longer maturity treasuries, like the 10-year yield. The yield curve is inverted. And so this has been right every time. If you were to rely heavily on this and you'd say, all right, well, when that inverts, look at the track record, I'm going to sell.
Yep.
Well, this time around, rules are made to be broken. The Treasury yield curve inverted on November 11th of 2022. That was pretty much the market bottom for the S&P 500. Since that date, the S&P went from 4,000 to almost 5,600.
You were looking okay for a month or so here.
Yep, and you would have missed out on all of it. So never rely on one silver bullet. Every recession rule is made to be broken. And the fact that everybody knows a recession rule exists means it's more likely that it has less predictive power in the future, because everybody will start to second and third order think around that, and the market will behave differently. The SOM rule is another example.
Yeah.
The SOM rule that we talked about in our last video, it recently triggered. We're right now in a position where the US Treasury yield curve is inverted. The SOM rule has triggered two of the best historical track records recession indicators, and we'll see what happens. Maybe both of them could be broken this time around.
Yeah, and to our point on the pitfalls of looking at the wrong data, there's a decent chance that labor market numbers get revised and the SOM rule untriggers, as it has done a handful of times in its past. Yep. And so I think that's a perfect segue into our recession signal, because we do have the yield curve signal as a component of our recession signal, right? And that's been active here for some time, as we just talked about. Mm-hmm. But the recession signal is designed such that we aren't relying on one silver bullet. We have these other three signals within the overall recession signal that we need another one of these to activate before we would feel comfortable talking about a recession or positioning for a recession. Yeah.
Just how we constructed this. There are four key elements to the recession signal: yield curve, real economy, labor market, and market stress. Each of those consists of multiple historically reliable recession rules that are made from what we think are the right data, high quality, frequent, subtly revised data. A lot of it is market-based. And most, if not all, of each of these underlying signals has to trigger in order to activate the higher level signal. Right. So you can see it's a layered diffusion type recession signal. And you go down and you say, well, what does that mean right now? Well, we need 2 out of the 4 high level signals to trigger in order to say, we think the market is going to behave as if a recession is imminent. We only have one of them currently. We see some yellow and red in the real economy and in the labor market. We're not there yet. It may seem like splitting hairs. We're getting close to these trigger levels, but the US economy is innocent until proven guilty. Yep. A lot can happen. And we also think within the real economy, although we're seeing some yellow and red, it's actually going to be tough to get to those trigger levels just based on the current trajectory of the data and what we're looking at. Same thing with the labor market. And then finally, you have market stress. It's really important. Once again, we're not trying to predict the ember recession band. We're trying to predict when the market will start to behave in a recessionary fashion. And to do that, you can take sort of leading indicators within financial markets, and that's high quality data. It's not revised, it's daily, yep. And it measures the consensus. So that's a big component as well. High level is our recession entry signal not active. If it were to activate, we know exactly what that means in terms of how we should shift client portfolios. And then once we're in it, we're waiting for the exit signal.
Waiting for the exit.
Yep.
Yes, sir. So no recession signal activated just yet from our perspective, but we thought this would be a great video for our viewers to understand the potential pitfalls of investing throughout a recession as it kind of becomes more in vogue narrative-wise here. But that'll do it for us here today. If you have any questions or comments, please feel free to reach out.